In this lecture, I want to talk about futures term structure and the two main forms of that, which are contango backwardation, as well as talking about something called roll yield. So to get started, let's just begin by thinking about gold. So there's a price for gold that's called the spot price or the cash price, and that is the price that's the current price. If you just want to go to a store and buy gold, if you want to buy the physical gold for delivery today. And you can always go to Google, you can just type in gold spot price. And we can see here that the spot price for gold as of, I assume as of today's a weekend, so as of yesterday, it was $15.73 roughly, $1,573.30 for an ounce of gold. Now, there are different ways of buying gold. I could buy gold for delivery today, which would be the spot or cash price, where I basically go to the counter, give them some cash, and they give me a few gold coins or a gold bar. Or I could buy gold to be delivered at a later time. So let's think about the pros and cons of this. Today, as we said, the gold spot price or cash price is $1,573. So that's if we want to pay cash. What if we want to buy gold in 12 months from now? Well, we would expect gold to be trading at a higher price. Now, I should distinguish something that often confuses new traders. We're not saying that we think gold is going to go to 1,600 in 12 months from now. That's not exactly what we're saying. What we're saying is you could buy gold today for delivery today, spot price, or you could buy gold for delivery in 12 months from now. We're not saying what you're going to pay in 12 months from now for gold, but what you're going to pay today to have gold delivered to you in 12 months from now. And you can see that gold 12 months from now is a little bit higher. It's at $1,600 instead of $1,573, $1,600 per ounce. Now, why would it be higher? Why would we'd expect the price of gold for delivery in 12 months from now to be higher than it is today? Well, there's a number of things that the seller would need to do in order to give us gold in 12 months from now. They would need to buy the gold today or have the gold today, in which case, if they didn't have the gold, they'd have to buy it for about $1,573. And then they would need to put it somewhere safe, especially if we're talking about millions or billions of dollars worth of gold. You're not just going to stick it under a mattress if you're an institutional investor or trader. And so if you're a gold seller or supplier, you would need to store that gold over the next 12 months. And there's a cost of storage. You got to put it in a secure vault. It's got to be guarded, etc. There's also, especially if you're talking about a lot of gold that's very valuable, if a bank has gold, for example, there are insurance costs. You'll want to insure it against the risk of theft or the risk of maybe a tornado hitting the vault and just moving the gold somewhere so the gold goes missing. So if you're going to deliver gold in 12 months from now, there's the current price today. You got to buy the gold. You got to pay for storage costs. You got to pay for insurance costs. And then what we often forget is there's an opportunity cost of money as well. And so if you are going to, let's say we don't buy gold today. Instead, we're going to enter into an agreement today, a futures agreement or a forward agreement to buy gold in 12 months from now. Well, there's a nice thing about that. Instead of locking our money up in gold, locking this 1573 up in gold, we could stick it in a savings account and get about 1.5% to 2% today. And so there's also that opportunity cost. If you're holding gold, you're not holding cash and you're missing out on some interest income. So these are the three reasons: storage, insurance, opportunity cost. These are the three reasons why we would expect the price of gold for delivery in 12 months from now to be higher than it is today. And if we look at the gold futures curve, it's often called the futures curve. It can be called the term structure. There are various names for it. I just went to the NYMEX here, to CME Group. I looked under settlements, Friday, January 24th, 2020 settlements. And you can see here, these are what we call the futures prices, obviously. But what they really are is the price today to have that gold delivered to you in the future. So right now, there is a January 20th contract, January 2020. You can see that the volume has really fallen off. This is about to expire, about to enter the delivery period, first notice or delivery period. And so this is very close. You can see 1570. This is very close to what we saw the spot price is. So the front of the futures curve you would expect to be very close to the spot price. And then we have gold for delivery, in February 2020, December 2020, December 2021. It goes out. it goes out. And you can see the settlement prices here, the open interest, etc. Now, instead of plotting this as a table, what if we plotted it as a curve? And so that's what we have here basically. On the bottom, on the x-axis here, on the bottom axis, we have various points in time: May 2020, December 2021, December 2022. So this is the time axis down here. And then we have the price axis up here, the price of gold for delivery at those dates. So the spot price is pretty close to the front of the curve here. And then we have gold for delivery in, call it a year from now. This looks a little bit, this is January 23rd, so it's a little bit different from the prices we saw, but basically close to 1600 in a year from now. Now this curve, you can see how it's upward sloping. It's upward sloping over time. It's basically saying the price for gold delivery is going up over time. So if you want it delivered in 6 months from now, it'll cost you a little bit less than if you want it delivered in 2 years from now. Now this is called a normal term structure. It's upward sloping, it's positive sloping. It's also often referred to as contango. So if you hear someone say, oh, the gold market's in contango right now, it is what we would expect for a normal commodity. A normal commodity, we would expect that because of these storage costs, insurance costs, and the opportunity cost of holding it, we would expect prices for future delivery to be higher in the future than they are today. So just keep this vision in your head. This is sort of a normal term structure, contango term structure for gold futures. Now let's look at the other kind of term structure that you may often hear referred to, and that is called backwardation. So here we have a chart of the term structure of crude oil. You can see CL. And I should mention that the website I'm using here is called spreadcharts.com. They've got a little app that works in your browser. And you basically go in here and you type in the commodity you want, you type in term structure and then the date, and then you click chart. And again, these prices are delayed by a day or two. It's a basic, you get the basic idea. So the price of gold, and then it's what's nice, if you mouse over this, it tells you each contract. So here is CLH20, crude oil, March 2020, expired in 29 days. Settlement price was $56.74. And then you can go out, say, a year from now to January, January 20th, 2021. That's CLG 2021. That price is $53.68, expiring in 364 days, basically a year from now. Now you can see that this is sloping in a different direction. So gold had a contango term structure. It was upward sloping. Crude oil here is downward sloping. This is often called an inverted market, an inverted curve, a negative sloping curve. And the main term for this that you'll often hear is a very fancy term called backwardation. And I've often wondered why they don't call contango forwardation. That might be a better word for it. But it's basically backward plus ation. Backwardation just means a downward sloping term structure. So you have all the different delivery dates here. Now, what is this telling us? Well, this is very strange because obviously, as we saw with the price of gold, if you're going to hold a commodity over time, there's storage costs, there's insurance costs, there's the opportunity cost. And so normally you would expect commodity prices for a commodity like gold or crude oil to be higher in the future. So this is unusual when a market goes into backwardation, especially a physical commodity market. It doesn't happen all the time, but let's think through why something like this might happen. Well, the main reason normally is that there's some sort of supply shock happening at the front of the curve. Because if you think about it, if you're a rational actor, why pay $56 today for oil when you can just wait and pay $53 for oil or $54 for oil and say, I'll pay for it now. I'll enter into this forward agreement, this futures agreement now for delivery in 12 months from now. I don't really need the oil, and I much rather pay $53 than $56. Well, it turns out that if you're running an oil refinery, maybe you need oil to run your country. You need oil for various industrial processes. Normally, if you're making gasoline or heating oil or something like that, if you're refining oil, you might just need oil today. And so having it delivered in 12 months from now, even though it costs less, is not going to do you any good. You need oil today. You need to put gas in your car. You need to create heating oil to heat your house, etc. And so what happens, the normal reason you get backwardation is because there is some sort of supply shortage. There are people who are desperate buyers at the spot price and in the first few futures months. Maybe there's been an attack on an oil line in the Middle East. This current term structure you could attribute to sort of the tensions with Iran that have been going on at the beginning here, January of 2020. And fears of war or supply cutoffs from the Middle East. And so this is what happens. This is what gives you backwardation. You could get a similar structure. Let's say these were corn futures, and there was a real drought in the middle of the summer, and people were expecting corn shortages. And if you're an industrial manufacturer and you need corn to make your breakfast cereal, you need the corn today, and so you're willing to pay up. And it's not going to do you any good to buy corn 2 years from now. You need it today. So this is one reason we would get a backwardated market where it's downward sloping. Now, what are ways to profit from a market like this? Well, I can tell you about a trade that I was doing in the early 2000s, and this happened when crude oil was trading at much lower prices. It was trading around $20, $30. And it looked like this. The spot price was maybe $25. And then you could buy oil further out, a year or two out, at something like $20 or $18. So let's think about what happens when you're trading backwardation, and I'll show you how that trade worked. We'll use these numbers here to make it really easy. So we know we can lock in a futures price here, January 20th, 2021, delivery in 364 days from now. We can buy oil for $53.68. So we would just go to the go to our broker and buy the January. Well, it's not listed right here, but the January 2021 crude oil. And now let's say that oil prices, currently oil prices are, let's just use this March. Let's pretend this is the spot price. It's $56.74. So we're going to buy, let's just write down these numbers. We're going to buy oil at $53.68. And then we'll say the spot price is, just to make the numbers really easy, we'll say the spot price, let's call it $57.68. So if we buy oil for delivery in 1 year from now, what's going to happen is we can just hold that futures contract, and the futures are fairly liquid going out that much. And if 12 months from now, let's say the spot price of oil doesn't move, and the spot price, the cash price for oil in 12 months from now, in January of 2021, let's say it's still right where it is right now at $57.68. Well, in that case, this price of this futures will be trading at $57.68 because it's basically the market pricing what oil is for delivery in January of 2021. And what essentially happens, it's called rolling up the curve. So if a market is in backwardation and you think that the current price, the front of the curve, is an accurate representation of where prices are going to stay over the coming months, you can buy the commodity at a discount using a 12-month futures account, and you do what's called rolling up the curve. You roll up the curve. And so when this contract, in 12 months from now, when this contract is getting close to expiration, it's going to be trading very close to the spot price because it is basically a contract that says, what are you willing to sell me oil for delivery in January of 2021? Right now, selling it at $53.68, but as it becomes close to January 2021, this futures contract is going to trade closer and closer to where the spot contract is. And so it's basically, as you hold this curve, you're going to make a little bit of money. As you hold this January 2021 futures contract, you're going to make a little bit of money every day. It's going to slowly appreciate up to the spot price up to 57.68. So in this case, you're going to make 4 points. So if we just take 4 divided by 53.68, you will make, that's about 7.45%. And again, this is a long trade. This is a position trade where you basically buy these futures. You don't have to roll them or anything, and you hold them close to expiration and you roll up the curve. And this is what I was doing in the early 2000s. Is we were able to buy crude oil for around 20 here, and the spot price I believe was around 30, may have been high 20s, and it was absolutely amazing because you could roll up the curve. You could make 50% over a year or two. And again, these are unleveraged numbers. So this is if you put $53,680 in that account. But let's say you only put a quarter of that as margin. Then you're basically making 4 times this, which is basically, call it 30%. So this is a very low stress way of making, of trading backwardation and rolling up the curve and allowing this to, allowing the inverted curve, the backwardated term structure, allowing you to purchase oil basically at a discount and then profit from it over time. Now, this only works if your view of the market is different from what the market prognostication is. So let's say that the market turns out to be correct, and oil in January of 2021, for January 2021 delivery, let's say oil really is at 53.68. In that case, when this contract comes due, when it gets close to expiration, it's going to be trading very close to 53.68, in which case the market, quote unquote, prediction was correct. And so if you buy something at 53.68 and you sell at 53.68, you're not going to make any money on it. So in order to make money on the futures market, especially in a backwardation trade like this, your view needs to be correct, and it needs to be different from what's priced in. So if oil really is going to be at 52.50 in July of 2021, you're not going to make any money. The futures market is correct. So that's one way to trade backwardation. You can roll up the curve. And so that can be nice. That can be a good way of trading it. Now what happens if you're doing a contango curve and you're holding it? Well, this is where you can actually lose money. So let's take a look here. We've got oil in, let's say, we'll use round numbers here. Oil in May, this is the gold term structure. And again, it's in contango, it's upward sloping. Gold for delivery in May of 2021 is about 1,600. And gold spot today, as we said, is, we'll just use this price here. We'll call it 15.65. So there are a couple ways we can trade this contango market. If we believe that the spot price of gold is going to stay right around here at 15.65, what we will then want to do is take a long dated contract like this May 2021. We want to short it because we're betting that we're going to roll down the curve. And what you can do is if you're short, you roll down the curve in contango. And what we're basically betting is that oil prices, spot oil prices, are going to be right around 15.65 in May of 2020. And what the futures market here will allow us to do is actually to sell that gold for $1,600 an ounce. And then as it gets close to expiration, it's actually going to be trading closer to 15.65. So we'll make what? 1,600 minus 15.65. That's 35 points. I'm sort of blanking on the multiplier here. I believe it's about $1,000. So it'd be, call it $35,000. So anyway, either way, we would be making money because we're selling gold at a higher price than where it's actually going to be traded. Now again, if the market is correct, if the futures market is pricing in gold at 1,600, and it turns out when we actually get to May of 2021 that gold is trading at 1,600, well, we won't have made any money. We would have entered at 1,600, the contract we'd exit right before expiration at 1,600. And so again, you have to have a variant perception. You have to have a different view of where the market is going than the market does. So that's how you can use Contango for your benefit. So basically, we saw how you can roll up the curve in a backwardated curve. You can buy the commodity at a discount, and if you're right that it's going to stay close to the spot price, you roll up the curve. In a Contango market, you can go short, and you can roll down the curve. Now, what happens in a Contango market if you go long? Well, let's say we, instead of shorting gold in May of 2021 at 1600, let's say we go long gold at 1600. And we're bullish on gold. And let's say that gold doesn't really move in price. The spot price stays around where it is today. Call it 1565. Well, what happens then? Well, we basically buy the gold. Again, we're going long the futures contract here. We're not shorting it. We buy gold at 1600. And then when it gets close to expiration, we will roll down the curve. Gold will be trading around 1565 in May of 2021. And so being long gold, we will have lost the same amount of points. So 1600 minus 1565, we will have lost $35 on this trade. And so that can be one problem with Contango. Now, the reason for this, it goes back to our original view here, where basically there's a cost of storage, there's a cost of insurance, there's an opportunity cost, etc. That is all baked into the price of gold. And so if you enter here at 1600 and nothing happens to the price of gold, you're basically paying $35 here in opportunity cost, storage, insurance. You're not paying it directly, but you're paying it through the derivatives market, through the futures market. And that's why you kind of roll down the curve here and end up losing money on the trade. So that can be the difficult thing about being long a market that is in Contango. There's a constant cost to it. And that cost shows up if you are holding various equity ETFs, or I should say commodity ETFs. So let me give you an example. But before I give you that example, let's look at our final example of a kind of a weird term structure. So again, here is gold term structure. It's in Contango. It's upward sloping. Prices go up over time. Here's crude oil, which is normally in Contango, but right now it's in backwardation. It's downward sloping. Price of oil for delivery in 6 months, 1 year, 2 years from now is less than the spot price or the close-in futures contracts. Now we're going to look at a really weird term structure that is famous for having a weird term structure. This is natural gas, NG. And you can see that you get these little humps in the term structure of natural gas. So you've got a hump here, and it looks like that's kind of November through February of 2021. You've got a hump here, November through February of 2022. Now, why might we see these humps in the winter? Well, the main reason is simply because more people need to heat their house in the winter, certainly in the northern hemisphere. And as a result, natural gas prices are higher in the winter, simply because there's more demand for natural gas in the winter than the summer. You don't really use natural gas to air condition your house, but you do use it to heat the house. And as a result, what the market does is it prices in higher natural gas prices in the winter than in the summer months. Now you can see here what the market is pricing in is slowly higher natural gas prices. And again, this is because of what we talked about, storage, insurance, and opportunity cost. So if I want to buy some natural gas here and I want to sell it in the future, maybe sell it in the winter of 2021, I will need to store it. I will need to pay for storage costs, insurance costs, and then there's the opportunity cost of having my capital tied up in that natural gas. So that is, you can see here that basically the natural gas market is in Contango in the front months. It's upward sloping. And then it has a little bit of backwardation as you kind of move from winter to spring in these various transition points. Now, what happens if you buy the natural gas ETF? The unleveraged one is called UNG. UNG is the ticker, United States Natural Gas Fund, LP unit. And you can see that this has been a really bad investment. It starts at the upper left-hand corner and goes to the lower right-hand corner. Again, this is trades like an ETF, and it is, I guess it's technically an investment trust. It's structured as an investment trust, but it trades like a stock. Trades like a stock. You can buy this. You can buy one share for $14.61. But when you look into what you're actually buying, if you go in and look at the holdings of UNG, the main holding is the front month of natural gas. So in this case, they have most of the value, in this case $526 million worth, tied up in these natural gas futures, March natural gas futures. And then the rest they just have in cash and in treasuries, but those are much smaller amounts. But this is basically the holding. So if you buy UNG, you are holding a contract. You're holding a trust that will always be holding the front month in natural gas. Now, what's the problem with holding the front month in natural gas? Well, if we look at this chart, we can see that the front month is in Contango. And so if we, let's say that okay, this is the January, February. Okay, so here's the March contract, and we saw that they are holding the March 2020 natural gas contract. So if we go right here, that is trading at 193.50. 193.50. Now, what they're going to do is, as this gets close to expiration, they're going to roll out to a future month. So they're going to be, instead of being long the, here's the March. Instead of being, NGH. It says February down here, but it's actually, this is the March contract. Instead of being long the March contract, they're going to be long the April or the May contract. And the problem when you're in Contango, as we saw with gold prices, is that if you buy up here and nothing happens, you basically roll down the curve and lose money. And that's exactly what's happening with natural gas. And that's one reason that this contract basically always goes down, unless you have some sort of real big spike in natural gas prices. But over time, you get a lot of decay. And the reason for that is you're constantly buying a couple months out in natural gas, and then you were rolling down this. So let's say you're buying here at 199, and then you're exiting at 193, assuming prices, the gas prices, natural gas spot prices stay right around 190, 193. Well, in this case, you're losing about 6 cents every month. And when you take into account the leverage employed, basically, if a market is in Contango and you stay at the front and you buy the contracts and then keep rolling out, you're always going to be losing a little bit of money every time you roll. So, for example, I'll buy this here at 199, 1.992. I'll sell it at 1.935. And then maybe I'll do the same thing again. I'll roll out to the next month, which is at 1.992. And then a month later, I'll sell it at a lower price. You're basically rolling down the Contango curve the entire time. That's why these natural gas, most of these commodity products, commodity ETFs or trust units, lose money over time. It doesn't mean you should short them, because you can get some crazy spikes where they will move up. In this case, this has had a lot of reverse splits because it just goes down, down, down. But that's one reason it's much better to, well, let me put it this way. If you're going to hold a commodity ETF, you need to be very aware of the term structure, whether it's in Contango, whether it's in backwardation. So if, for example, if we're looking at the crude oil one, I believe the ETF is USO. And this functions in a similar way where they hold the front contracts. You can see it hasn't been quite as bad. It's been sort of going, it's been going sideways. And so the nice thing about owning USO at the moment is that basically you are rolling up the curve. Now it looks like the front of the curve here is not that steep. So March delivery 56.74, next delivery 56.76. That's actually in Contango there, and then it goes down 56.66. So it's back in backwardation. So all your friends who own natural gas ETFs or crude oil ETFs, this is something that they should be aware of, and that you should be aware of as well. That this Contango can really hurt you when you're long a product like this. So that's the basic summary of contango and backwardation. I think there's one more concept that I should cover before we move on, and that's what's called cash and carry arbitrage. So if we go back to, let's X out of these. If we go back and look at the price of gold, if you are in a state of severe contango, so let's say that instead of this sort of natural upward sloping thing, let's say that gold prices, the term structure looks like this, where it's much, much steeper for whatever reason. Well, what will happen there is people will buy gold and they'll do what's called a cash and carry arbitrage. Cash and carry. And what this basically means, and you really need to have a lot of money, really be a big player to do this, but you buy gold in the spot market, in the cash market. And then you enter into a futures contract to sell it, call it 12 or 18 months later. And so let's say we buy gold here at, what did we say, 1573 roughly. And then let's say the price of gold is just crazy in a year from now or a year and a half from now. Let's say it's at 2000. Well, what I can do is I can buy gold, cash gold here. I can store it, I can insure it, put it in a very secure vault. And then what I can do is enter into an agreement to sell it 12 or 18 months from now at a much higher price. And so my profit on this trade is basically going to be, and then I should say, once we get to 12 or 18 months out, I will have locked in that price. I will deliver the gold. If I want to deal in the physical, I'll take the gold out of my vault. I'll give it to the people who agreed to buy it from me in, call it April of 2021, and I'll collect $2,000 an ounce. And so my profit is basically going to be the price I sold the gold for, $2,000, minus the price I paid for the gold, $15.73, minus the carrying costs. What's often called, I'm not sure I use that term, minus the carry or the carrying costs. And as we mentioned, that is just storage, insurance, possibly opportunity costs. So I'm not sure I'd count that in this case, but basically storage and insurance. And normally this is built into the market. These carrying costs are built in. So when you have normal contango here, it's just taking into account the storage and insurance and the opportunity cost. But if you get a very steep contango curve like this, there may be an arbitrage opportunity where you can buy gold today, agree to sell it in the future, and lock in a difference, a price difference that's greater than what it would cost you to store gold over that period. And so what does this do? How does this affect the curve? Well, basically, let's redraw our contango curve here. So we have normal contango, then we have severe contango. Well, what happens if people are doing this cash and carry strategy? Well, they'll be buying on the front end, which will drive up prices at the front end. They'll be selling to lock in that spread further out. And as a result, you'll have buying pressure at the front of the curve, selling pressure at the back of the curve. And what that will do is when the curve used to look like this, it's going to begin to maybe look like this. And so the back end will come down, the front end will come up. And what this means is that basically market speculators are taking advantage of this severe contango to lock in some profits. And what that does is it totally moves the whole term structure. And in general, when you see a severe contango, when you see a very severe contango, it's generally bearish for the future price of the commodity. So it's bearish because people are taking what the market thinks is going to be this future price, 2000, and they're saying that's too high. And they're selling the futures, and they're trying to drive it back down to what a more normal contango curve would look like. So when you see severe contango, if the market's wrong, and again, you can never, if you have perfect knowledge of the future, you can obviously make a lot of money. But traditionally, what I've seen at least, severe contangos is generally bearish for the future price of a commodity, simply because people are going to be doing this cash and carry arbitrage, and they're going to be driving the back side of the term structure down. So that's the basic discussion of term structure, backwardation, and contango. And again, this is not showing you, it's not showing you how the market is going to move over time. So this is the market's best guess of where future prices are going to be, but the market can be wrong. And if the market's wrong, if, for example, gold is not going to be 1,600 next year, but it's going to be 2,000, then there's room for arbitrage. You can buy the long-dated gold futures. You can buy the near-term futures and keep rolling them. But there's only opportunity if there's a mispricing. And again, the other thing to remember is that this we say this is a futures curve, but it's not telling you how the spot price is going to move over time. It's telling you how much does it cost to have gold delivered to me this summer in 2020, early 2021, early 2022. Not showing you how the spot price is going to move over time or the cash price, but showing you what it will cost you today to enter into an agreement to have some commodity like gold delivered to you sometime in the future. So it's always good when you're trading a commodity to be aware of the term structure, whether it's in contango, whether it's in backwardation, whether it's got some weird seasonal effects like natural gas has. And while you're doing that, it helps you have an idea of whether you're going to have negative carry while you're holding a commodity contract or positive carry. Now, if a market is in backwardation and you're long the market, as we said, you're going to slowly roll up the curve. And so you'll have positive carry. If the market is in contango, any kind of contango, you're going to lose a little bit of money over time unless the market moves. So if you buy gold here at 1,600 and the spot price doesn't really go up from 1,573 or 1,564, basically you're going to roll down the curve and you're going to lose money. So when you see a market that's in contango and you're thinking about going long, always be aware that you're going to lose a little bit of money every day. There's a cost to holding that futures contract. But if the market is in backwardation, you actually get paid. If you're long crude oil somewhere where the curve is inverted or backwardated here, you're going to actually have positive carry over time. You'll make a little bit of money over every day. It's similar to being long a dividend stock. If you're long a dividend stock, you basically make a little bit of money every day. You only get paid quarterly, get paid 4 times a year, but you make a little bit of money every day. That's positive carry. So if you're long a backwardated commodity, there's positive carry. Assuming things don't move too much, assuming things stay the same. If you are a long crude oil here and everything stays the same, you will roll up the curve. But obviously things can change. The market can change. Maybe there's a huge supply glut, and as a result, the new curve moves, and so it becomes, the front end goes back to 20, drops from 50 or 60 down to 20, and then you were long the December 2021 at 53.96, and let's say the new curve looks like this, and the price of that December delivery moves down to 30. In that case, you will definitely lose money. So don't think just because a market's backwardated that you'll automatically make money. But all else being equal, if a market is backwardated, you will roll up the curve. You will have positive carry. You will make a little bit of money every day. If the whole curve switches, as it did here, the price of your December 2021 futures can move from 53.96 to 30. You lose a lot of money. But the main reason to pay attention to term structure is to give you an idea of whether you have tailwinds or headwinds. And if it's backwardated and you're long, you've got a little bit of a tailwind, assuming you're correct and you're bullish on the commodity and it performs well. If the market is in contango, you've got a little bit of a headwind. You're losing a little bit of money every day, and every time you roll, you're basically going to be buying. You're going to be buying high and selling low, and then you'll buy the next contract, and it will roll down, and you'll be buying high and selling low. So that's term structure. There's a lot more we can talk about this, and when we talk about trading futures, credit spreads, we will revisit term structure. But I just wanted, when you're normally trading stocks, you don't think about carrying costs, contango, backwardation. And so it's important to know the term structure of the commodity you are trading.